welcome back, you guys. We're going to continue on with a couple of little things in terms of mathematical foundation, but keep in mind this is still going to apply right directly into our markets as well. The two things we're going to go over today is percentages and compound interest. Now, what is it that we want to make sure we understand about percentages? Is there, I also teach math for high schoolers and SATs and something. There's actually this very common problem. This common problem asks us, if you go down 25% and then come back up 25%, what are you at? And the most common answer is going to be you're back at 100%, right? You have 100%, go down 25, come back up 25, you're back at 100. That's the common approach, but unfortunately, that's actually incorrect. What I want to show you here is just a little bit of all that, all right? What we've got here is we've got that formula I touched. So if you had $100 and let's say even you went up 25%, that would be 125 bucks. You go down 25% and you're down to 75. But here's the thing, if you go down, let's say you start and you go down that 25%, you're at 75, and you take that 75% and you add 25% of that 75, you're actually back down to $93.75. So you're actually going to end up being a little bit lower than the 100 that you started with, okay? Or 100 that you started with. Now, that's one thing about percentages, okay? Percentages, it takes more, right? Reclaiming 100% is an uphill battle. So to get back to 100%, right? Even if you're down 1%, you need to come back 1.01. But as each number gets bigger, the return gets tougher, okay? And here's one to really consider. 90% down means you need 1,000% to come back. You need a 10x return, okay? So that would be if your $100 went down to 10, you need to multiply 10 by 10 to get back to 100. So what this means is it takes more return to counteract any sort of loss. Now, that's something really important to consider. Anytime that you have a percentage down, coming back takes more, okay? And the more you are down, the more it takes to come back. And that's one of the things people don't realize is, as much as these numbers make sense, yeah, of course, you never want to be down 50%, never want to be down 33. A part of the markets that's really tough is your emotions when they get involved, your fear of missing out, the FOMO side of things. I understand Chemo's name on the Discord is FOMO Chemo, but it is an ironic type of use because, again, that type of mentality is actually what ends up putting people into these situations where they're going to be down more than they should have been. Now, there's a bit of, that's where the psychology, that's where the numbers and percentages really do come in. But the first thing I do want you guys to remember is reclaiming 100% is an uphill battle, and down and up are not always going to be the same back to 100, okay? Now, let's continue. I teach high school math, high school, middle school, college kids. I love to teach calculus in particular. But one of the things that is embedded within all of it is this concept of continuing to multiply, but at a small percentage rate. Okay, what that means here is, in case your math teacher forgot to teach you, there's a power in compound interest and consistent small gains. So for example, earlier we were talking about bigger losses or bigger gains. Here we're just saying a 5% interest or a 5% gain on an investment. What you can do here is you can put on the power addition, how many time periods happen. And here, 2, you can continue 3, 4, 5, 6. So the formula is what you start with, the percentage added to 1, and then how many times, that's your final. Okay, so that's just math. Ultimately, what it's showing is that depending on the start, right, that percentage that's tacked onto it can definitely be a decently leveraged amount. This actually should be 10 right here. Let me fix that. Okay. Now, there's this rule that also tells us compound interest. If you had a certain percentage interest, you take 72, divide it by that number, and that's how many years it takes you to double your money. Okay, 3% interest, 24 years, or in this case, 24 times of 3% will eventually get you to double. And so depending on your interest rate, if you can tackle 10%, it's 7 years in this situation of continuous compound interest. So the idea is that money can multiply even at small rates of interest, small rates of gain, as long as it's consistent, can actually create quite large returns over time. Here's an example too. Right here, we're just going to say 5% gain. You start with 10K here. You could take off zeros, so like $1,000 as well, right? Or $100 even. After 5%, right? It continues to go up. It takes 13 to 14 times for you to double your money to get 100% return. Then as you continue, each continued return, you notice the doubles start to stack up faster and faster, meaning that you're ultimately going to find a multiple or a more of a return after a certain amount of time, or a certain amount of 5% returns. You start to actually get that that initial starting investment. It starts to be a part of the return almost every single time. So here it's just showing compound interest. There's a lot of gain to be had, but it's about consistent growth. And with another thing to remember is it's also making sure that with consistent growth, you also don't ever end up in a situation where you need to come back, right? Portfolio protection is just as important. So percentages and compound interest, I'm going to leave you down here with this other thought here of how we are looking for a low risk, high reward situation of probability. All right. In that situation, that way we have higher probabilities of getting that return that we're looking for. But one thing to consider too, and because a lot of times the marketplace and the options do get labeled as a casino. And one of the first things I want to open your eyes to, another thing that we really emphasize in these lessons, is that just like a casino, the marketplace and the options marketplace, they're actually businesses. They're businesses that originated in order to fulfill a need of sorts. But at the end of the day, everything is calculated with mathematics, and everything is calculated with probability. In a casino, the amount of risk you're willing to take directly leads into the amount of returns that you may see. But ultimately, the house will always have some form of an advantage upon the people, upon the players. And here you can see with a casino, with every $100 that they bet, they can expect to lose a certain amount of money, and it's a small percentage. But to keep in mind, if the casino itself, the business, has it set up where they can do hundreds of thousands of these in a day, it adds up. Okay. Casinos are profitable businesses. Why? Because of the mathematical planning, the law of large numbers, which is linked into that marble jar that we're talking about. They aim for many, many marbles, all right, as many marbles as possible. That's why they try to get you into the door and get you to spend money there by giving you incentives. But in a casino, high risks lead to high rewards. Lower risks lead to lower rewards, all right? And that's pretty straightforward in terms of that. So it kind of does make it a situation where, how are we going to necessarily find this low risk, high reward? How is it mathematically preferable, right? because this has the best probability of gain. Well, look at it this way. We're looking for high return situations. Obviously, with a water bottle, we could buy at a low unit and sell for potentially up to 100% of that initial investment, versus it wouldn't necessarily be worth it to gain that same one by investing into something much, much larger where your percentages are not going to worth it. Your risk is much higher for a much lower reward versus you have a much lower lower risk for a higher reward. What you're looking for is you're looking for a situation where you have reward and risk that can be balanced out in order to get higher reward to risk. Okay, we're going to balance out that risk and reward and effort. And so we will, we'll say ultimately we're looking for at the least this 3 to 1, 1 to 3, 1 to 3 the reward, 3 to 1, where we have 3 units of profitability for every 1 unit of risk. Think of it this way. I mean, casino, we're going to try to get away from the casino type of analogy as soon as we can. But one of the easiest ways that I would say to think of this is, let's say you're playing blackjack and it's $100, right? $100. What if every hand you could potentially make $300 by only risking 100? Okay, because it could drop that, but again, you can win that 300. So actually it would go to 400. It would take multiple probabilities for you to end up losing that, and you only need to win 1 time, and that would end up giving you 3 more risks, if that makes sense. So creating these situations where we're looking for positions of higher reward to lower risk, that's ultimately a good trade, because therefore we're letting probability and the mathematics of the situation actually help us out, right? Real quick, we're going to jump straight into our charts, and we're going to turn off some of these other things. All I'm trying to show you right now is a bit of the risk to reward and how we might want to visualize that. All right. Now, what we're looking for in these situations is, the one way you can think of risk is, even in that blackjack situation, being able to pull your money off the table early at a smaller loss if you see something going the wrong way. Right now, in terms of the marketplace, there's a lot of stuff going on, but I would even say right here, what you could say is we could put this, if we expect it to go down, we may target certain previous prices, okay? But here it's going to say, if I allow my risk to be all the way up here, the risk to reward ratio doesn't make sense. Remember, I'm looking for a 3 to 1. So if I'm aiming for that range down there, this range down here, the area that would tell me I should get out is going to be much, much smaller, right? Now we'll get into more details as to how we're going to plan these out, where we're going to set them up, etc. But what I just wanted to point out in terms of finding these charts, on the left side here, you have a prediction and measurement tools. Long position is aiming upward, expecting price to go up, right? So for example, if price were headed back up in a direction, I could set it up for a 3 to 1 risk to reward ratio, or even more, depending on what type of situation I'm looking at, okay? There's data in here that, as we continue with the further classes, you'll start to understand what is being looked for, what it is in terms of our indicators, et cetera, that we want. But here, just understand, play around with these tools on TradingView, long position, short position, and understand that, hey, if you were to get into this trade, even if I was to say down here where we are, the gray line is going to be where you're at entry. The green is how much your reward is looking for, and then your red is going to be your risk. Everybody's risk profile is going to be a little bit different, but keep in mind, a good trade starts with looking for that risk to reward ratio of at the minimum of a 3. If you can get this to be greater, those are great, better and better situations to be getting into. But keep in mind, There's still many more things we're going to talk about. This is still just the beginning. All I wanted to do with this specific lesson was to make sure that we went over our percentages, our compound interest, and of course here a little bit of our risk to reward ratio. All right. With that being said, I'll see you guys in the next video, and we'll be applying these concepts very, very soon. See you then.